All right. Hope that everybody can see my slides.
Yes, we can. Thank you.
So this is a very ambitious topic to talk about the global economy and the investment climate. So let me start by saying, in fact, I'm only going to talk about the United States. If people want to ask questions about outside the United States, I certainly have some opinions about that. But the United States is still almost 25% of the world economy, and it's the economy that most of us are part of. Also, everything here is just one person's opinion. There's a phrase that I'm sure many of you are familiar with, strong opinions weakly held. And so that's what I'm going to be sharing today. So first question, obviously, is, are we in a recession? Is there going to be a recession soon? And I think the answer to that is pretty clear. We're not in a recession right now, but there will be a recession at some time in the future. That recessions have not been abolished. And there's been a lot of talk recently, different CEOs have been saying there's a hurricane coming. Lloyd Blankfein, who's somebody that I respect a lot, the former CEO of Goldman Sachs, and he led Goldman Sachs through the financial crisis, and Goldman Sachs survived the financial crisis better than any of its competitors. And he's just said, quoted today as saying that some of the negativity about the economy is exaggerated. And I think that's certainly the case. And the reason fundamentally is that recessions don't happen because people are talking about recessions, and recessions don't happen because things are happening that people are discussing and expecting. Recessions happen when there's a surprise event. There's always going to be surprise events in the future, so there always are going to be recessions in the future, but you can't really predict them. There's a famous saying from Paul Samuelson, who was one of the leading economists of the 20th century. And back in 1966, he said Wall Street indexes predicted 9 out of the last 5 recessions. And currently the stock market is down, so you could take that as predicting a recession, but chances are that it's going to be an incorrect prediction. Now, what is happening clearly in the economy nowadays is inflation. And what people have been saying recently is that Larry Summers, who's a very distinguished economist, former president of Harvard, he was an outlier, early last year. So this says he predicted that the current stimulus plan would set off inflation. And he was in a minority then, but it's clear that he turned out to be right. And I think something to understand, the Biden stimulus plan, it came on top of the Trump stimulus plan. It was late and it was very large. It was $2 trillion by some measures. And this wasn't an infrastructure plan, it was a spending plan. And so there's been a huge amount of spending in the economy, really since not long after COVID began. So people talk about a supply chain crisis in the global economy, and it's certainly true that there are specific issues of supply chain difficulties like lockdowns in Shanghai or difficulty of exporting grain from Ukraine. But the fundamental thing that's been happening is demand has increased in the United States, especially much faster than it was increasing in the previous years. And so there's just been more demand than there has been supply. This particular chart, it's the value of personal savings in billion US dollars in the US. And you can see from 2012 to 2019, personal savings in the US were pretty much flat at around 1.2 trillion. And then in 2020, personal savings more than doubled to more than 2.5 trillion. So this is basically government stimulus in 2020 that went into people's bank accounts. And then people started spending that stimulus in 2021, and that caused inflation, that caused demand to outstrip supply. And then in 2021, there was the additional stimulus, most of which probably was not needed at a macro level, and that's caused further spending, further demand, further inflation. So that's what I see as the state of the global economy. What about the investment climate? The long-term climate is favorable. And by long term, I mean a time horizon of 2 years or more. And the reason is that there's still this huge amount of savings in the economy, and interest rates have gone up, but real interest rates are still negative. Even if you're getting 5% on your savings, then you're still losing money when it comes to inflation. And so, people who have assets are very conscious of this, and they're looking for investments where they can get yield. As the second part of this extract says, the windfall is piling up at the top of the income distribution. About 2/3 of the excess savings were accumulated by the highest 20% of earners. So this is money that is looking for opportunities in venture capital, in real estate, and everywhere. There's this saying in investing that, don't fight the Fed. And ever since the financial crisis, the Federal Reserve has been stimulating the markets with quantitative easing and keeping interest rates low. And then the last couple of years, it hasn't been the Fed so much as it's been fiscal policy with stimulus. And if you look at this chart, this is savings deposits in trillion US dollars. So this is bigger than just personal savings, but this is essentially money that's in the economy that belongs to companies or to people that is available for them to spend that money, or for them, this is money that people don't want to spend, it's savings. So this is money that's available for investment. And if you see from 2000 to 2020, it's really been going up, pretty smoothly. You can see an acceleration starting in 2009 after the financial crisis. So this is the Federal Reserve putting more money into the economy and ultimately causing asset prices to go up to try to mitigate the recession after the great financial crisis. And you see, this has been a relatively smooth progression. And of course, the stock market has been much more volatile. I think there's a fundamental reason why the stock market has been volatile, and that is because late stage investors have a short time horizon. So this is some data that I just got from yesterday, Friday. But I think this is representative of the last few years and representative of tech companies in particular. So the market cap of Amazon yesterday was 1.2 trillion. And there were 4.8 million shares of Amazon traded yesterday. And so you might say, well, what does that mean, 4.8 million? Well, 4.8 million shares is $12 billion of Amazon stock. So that's 1% of Amazon's market cap changed hand on Fridays. So what this means is that the typical Amazon share, whoever owns it, they only own it for 100 days. The ownership of Amazon turns over twice a year. So the people who are buying Amazon shares on average, they're not buying it because they think that Amazon is a good investment for the next 10 years. They're buying it because they think that it's going to go up over the next few months. And so that's the short time horizon of investors. It's not the short time horizon of Amazon management necessarily, but it is of investors. So with this short time horizon in the public markets, you get a lot of volatility because people are not really trying to estimate long-term value. They're just trying to estimate what other people will be willing to pay in the near future. Now, early stage investments, so you're like Founders Fund is doing, are very different. They have a long time horizon. But there's a different fundamental property of early stage investments, which is that most of them fail, or most of them turn out to give a relatively small return on investment. And then a very, very small number of them turn out to be grand slams. An example is Facebook or Google, or in fact, all the big tech companies. Those are the 1 in 1,000 grand slam early stage investments, maybe with Snowflake being the most recent example. And if you think about that from a mathematical point of view, so on the left here, the blue curve is what's called a normal distribution or a Gaussian distribution. And so it has what's called light tails. The probability of getting a sample which is very far from the average is very small. Those blue tails go down to zero quickly. But a Cauchy distribution is a distribution with very heavy tails. And the fact that the probability of getting a very large observation is small, but it is much, much larger than with a Gaussian distribution. And so this picture on the right, it's a mathematical simulation of what you could say making investments, but this is just samples from a Cauchy distribution. And the red line is the average of all the points so far. And you see, it happened that early there was a very bad point that pulled the average way down. And then, then you got a lot of points that were near the center of the distribution. The average gradually went towards zero. And then randomly, there was an extremely large outlier that took the average, off the chart, literally off the chart. And this is what it's like being an early stage investor. If you're fortunate, one of your investments pays back more than all your other investments put together. The mathematics of early stage investment is just different from late stage investment. Okay. Let me give some what I see about crypto and Web3, and this is based on what I know as a professor of computer science for many years, and also based on what I've seen from being inside Wall Street for several years. I think I would love to be shown wrong, but I still haven't seen major applications for cryptocurrencies beyond speculation. I just don't see them being used for real world transactions. And blockchains, I'm sure a lot of people have said this, but it's what I see. I don't see major uses for them except cryptocurrencies are one and collectibles are the other. Collectibles being non-fungible tokens, NFTs. And I was just trying to find some evidence to support or contradict this opinion. Like I said, strong opinion weakly held. And so on the IBM website, of course, IBM is bullish about blockchain. They want you to hire them as consultants to build you blockchain software. So right on the IBM website, it's IBM solutions built with blockchain. And what are they? Well, supply chain, health verification, B2B collaboration. I have a good friend who is a supply chain director at a Fortune 500 company with a particularly complex supply chain. And she just told me recently that there's zero use of blockchain in her company's supply chain, and there is zero use of blockchain that's on the horizon for her company and supply chain. So, people have been talking about blockchain for supply chain for many years, but it's not happening. Maybe it will happen, but it's not happening now. I think same for healthcare. If anybody has their COVID vaccine certificate on a blockchain, I would like to hear about that. And then B2B collaboration, this is buzzwords. So I'm very eager to hear about genuine applications. The three ones at the bottom are essentially blockchain software that IBM wants to sell you. They're not applications. As for metaverse, again, maybe I'm too old. I remember Second Life. I remember Linden Lab. And I particularly remember IBM jumping on that bandwagon and trying to sell second metaverse software in 2008, 2009. You can still find this frozen in time on the internet from 2008. So what are the fundamental obstacles to cryptocurrencies going mainstream? I think something that everybody on Wall Street understands, but people on Wall Street, people outside often don't understand, is that the financial system runs on human discretion. If you have a financial advisor and your financial advisor embezzles your money or steers you to wrong investments, then ultimately you have the opportunity to file a lawsuit, and you have the opportunity for a human judge to give you a do-over. And that's the fundamental difference between smart contracts and traditional contracts. So I wrote here, fiat financial systems run on human discretion, but In fact, it's not just fiat financial systems. Look at what happened recently with Luna and Terra. In practice, the humans intervene when something unexpected goes wrong. We just heard in the previous presentation, trust and safety, really important. Trust and safety and having humans working on that philosophically, that's the opposite of a smart contract. These extracts from the Financial Times from a few days ago are a fascinating story from March 2020. So that was the beginning of COVID. There was huge disruption in the financial markets. What this is saying is somebody from one of the big exchanges, Intercontinental Exchange, said that there was a major financial institution that was technically not solvent in March 2020. Technically, they owed more money than they could pay. And so if this institution had actually collapsed in March 2020, it probably would have been worse than the Lehman Brothers collapse. And there were people on the inside who knew that this could happen, and then they used their human discretion to prevent it from happening. The Financial Times, the journalist doesn't know who it was, but it says at the bottom, Citadel, Citibank, DRW, Jump Trading, Morgan Stanley, Virtu, or JP Morgan and Goldman Sachs. So it's probably one of these. Now, in fact, it probably wasn't one of the banks, because the banks are closely regulated. And something that people outside Wall Street don't necessarily appreciate is that when the various agencies are regulating the banks, they're not just making the banks follow the rules. They actually have humans from the regulators who are literally embedded inside the banks, who actually in the offices with the banks and monitoring what the banks are doing. And if the regulators don't like what the banks are doing, then they can tell that to the bank. And even if what the bank is doing is technically legal, if the bank wants to keep a good relationship with the regulators, then they have to listen to the regulators. So the human discretion in regulation is significant. And the flip side of that is that if the regulators think that a financial institution is basically honest and basically good, then in extreme circumstances, that financial institution will cut some slack. And that's how fiat financial systems work. And it's going to be very difficult for software-based financial systems to really work for hundreds of years without having that level of human discretion. That was my last slide. So happy to take questions, and especially happy